Although we're still concerned with overhead resistance in the US markets, we did just have our best 2-month start to the year in over 30 years. But what we're becoming increasingly concerned with is the foreign markets and all of the bad news that continues to pile up.
As Matt mentioned at the beginning, the US markets just had their best start since 1987. And last week we did see a mixed bag, as the S&P 500 was up about 0.4, the NASDAQ was up almost 1%, but the Dow Jones was just negative, and the Russell 2000 was also negative. Now the Russell 2000 is leading the way, up almost 18% for the year. We also saw different returns for foreign and emerging markets, as foreign markets were up about 0.8%, and emerging markets were down almost 1.3. The chart that we're looking at today is the Russell 2000. The reason we wanted to look at the Russell 2000 is because it's the last major US index to cross over the 200-day moving average. And if you've watched any of our videos over the past few weeks, I've talked a lot about the 200-day moving average, and when one of these indexes breaks up above that 200-day moving average, it's usually a good sign for the markets. Now, although the Russell 2000 breaking out above the 200-day moving average is bullish, we think it's more important to look at this blue box, and that's a clear resistance zone between 1600 and 1625. Now, if you go back and look at the beginning of 2018, the Russell 2000 clearly got rejected at this level twice, and then was rejected again in October of last year 2 times. Now, if you look to the far right of the chart, we saw the Russell 2000 just last week also get rejected at this same level. So it's going to be really interesting to see moving forward over the next few weeks if the Russell 2000 can continue its momentum that it's had so far this year, or if it'll get rejected at this zone again.
Not only do we have all of the US indexes now over their 200-day moving average, but also last week we had GDP numbers come out for the 4th quarter. And they came in at a little bit better than expected rate of 2.6%. That puts 2018's growth rate for GDP at 2.9%. That's the best over the past 10 years. As we said earlier, the positive news out of the United States continues to pour out, but the foreign markets continue to have bad news pile up. And out of Australia, which is one of the key components to the foreign index, they are actually stating that they now have a financial crisis on hand. And they're comparing their housing crisis to that of the United States in 2008. And the IMF is talking to Australian regulators and telling them to begin their financial crisis management, as they've seen home prices drop by over 10% in just a year. Also, one more bad piece of news for the foreign markets came out of Japan last week. And Japan has been one of the best performing parts of the foreign market index over the past couple years. Now, the Bank of Japan stated that they're going to begin discussing ways of ending their monetary easing program, which has been established for the past 6 years. But they also stated that they're very concerned that if they make one wrong move, that could cause a lot of problems for their financial markets. This is going to be a big week for the foreign markets, with the European Central Bank reporting on interest rates, and also the Eurozone GDP for the 4th quarter is going to be reported.
Also, Japan reports their 4th quarter GDP numbers, and this could either accelerate or slow down the talks of them easing their balance sheets.
Thanks for watching, and we strive to give you everything that you need to know about the markets in 5 minutes or less.
Like our Facebook page and share the video. Thanks.